For years, I've built my wealth using one of the simplest and most effective strategies out there, buying and holding the S&P 500. It's a strategy I've talked about a lot on this channel. It's the common sense advice given to millions by financial advisors. Honestly, it's a strategy that has made me millions. For decades, it was the financial equivalent of a superpower. Effortless, reliable, and powerful. But right now, a massive, once-in-a-generation structural shift. A tectonic realignment of the entire global economy is forcing me to make 5 urgent changes. All of this is driven by artificial intelligence. It's the very thing that made index investing so safe. Its broad diversification has been silently eroded. The rise of AI has created a hidden trap in the stock market, one that most people don't even know they've fallen into. Your so-called diversified index fund may have morphed into a higher risk, concentrated bet on just a handful of technology companies. This isn't diversification anymore. It's a gamble, and it could be putting unsuspecting investors on a fast track to financial ruin. Today, I'm going to walk you through the 5 specific actionable changes I'm making to my own money to protect my wealth. We're repositioning for the next decade of an AI-driven growth and disruption. This is not about fear, it's about adaptation. To get why I'm making these changes, you have to understand what the S&P 500 has become. It's supposed to be a diverse basket, but it's a market cap-weighted index. All that means is the bigger the company, the bigger its piece of the pie. Historically, the top 10 companies made up 19% to 27% of the index. By the end of 2000, that figure hit about 27%. But recently, that concentration has exploded, surging to nearly 41% for the first time in modern history. 40 cents of every dollar goes to 10 companies. The other 490 companies, from healthcare to energy, are just along for the ride. Their performance is almost irrelevant to the index's direction. Who are these companies? NVIDIA, Microsoft, Apple, Alphabet, Amazon, the titans of tech. The story driving their growth is overwhelmingly AI. Your fund is quietly turned into a highly concentrated thematic bet. You didn't choose to make that bet. The index's mechanics did it for you. This is the hidden trap. You're holding a massively overweight position in a single, volatile, and potentially frothy sector. Remember the dot-com bubble? The market was convinced the internet would change everything. It did, but that didn't stop the Nasdaq from crashing 78%. Fortunes were wiped out not because the internet was a fad, but because valuations got completely detached from reality. Pets.com and Webvan became cautionary tales overnight. The herding we see today feels eerily similar. Passive funds are forced to buy more as prices climb. This creates a dangerous feedback loop. You aren't making a choice. The fund's rules are pushing you deeper into the most crowded trade on Earth. In February 2026, we saw the first warning shot. Money started flowing out of mega-cap tech and into energy and industrials. This isn't a sign that AI is over. It's a sign that the easy money phase is ending. The exit door is very, very small. The market is starting to differentiate, and that concentration is now the biggest source of risk. That is precisely why I am acting now. If you're starting to see your portfolio differently, hit that subscribe button. We're about to get into the 5 specific changes. My first change, I am strategically cutting back my automatic investment in the standard, market cap-weighted S&P 500. I am not selling all of it. It's still a core part of my portfolio to capture the momentum of the market's biggest winners. But what was once a tool for diversification no longer works for that purpose on its own. It has become a momentum tool. A portion of that money is now going into an equal-weighted S&P 500 fund. Every company gets the same slice of the pie. Microsoft gets the same allocation as the 500th smallest company. This means the top 10 companies make up just 2% of the index. This instantly solves the concentration problem. You finally have more exposure to industrials, healthcare, and consumer staples, the backbone of the real economy. This strategy is a bet on reversion to the mean. Asset prices after extreme moves tend to return to their long-term average. By rebalancing, it forces you to sell winners and buy losers. This builds in a buy low, sell high discipline automatically. The main idea here is to be deliberate. I'm moving from passively accepting risk to actively managing it for the AI era. I am choosing to reduce my overexposure to a handful of AI-centric stocks instead of letting the market's manic momentum dictate my financial future. The second change I'm making is a deliberate and significant increase in my allocation to international stocks. For the better part of the last 15 years, the mantra has been us all the way. American stocks, led by big tech, have absolutely crushed it, and this has created a powerful home country bias in most investors' portfolios. But market leadership is cyclical. It never ever lasts forever. Assuming U.S. dominance will go on forever is just ignoring a century of financial history. In the 1980s, Japan was considered unstoppable, an economic titan that seemed destined to own the future. From 1985 to 1989, the Nikkei stock index more than tripled in a speculative mania. At the absolute peak of the frenzy, the tiny patch of land under the Imperial Palace in Tokyo was valued at more than all California. The bubble felt permanent. But when it burst in 1990, it ushered in decades of economic stagnation, known as the lost decades. The stock market crashed. Real estate prices plummeted by as much as 70%, and the economy entered a liquidity trap. From 1991 to 2003, the economy grew by just over 1% per year, and real wages fell. No country's dominance is guaranteed. Today, there are some pretty compelling reasons to look abroad. First off, valuations. After years of underperformance, many international markets are just plain cheaper than the U.S., while the S&P 500 trades at high-price earnings multiples. You can find high-quality companies in Europe and Asia at a serious discount. Second, the AI story isn't just an American one. The global supply chain for AI is incredibly complex and concentrated in non-U.S. players. Indispensable companies like TSMC in Taiwan, which is the world's largest foundry, are critical. Or look at ASML in the Netherlands, which holds a monopoly on the EUV lithography machines required to make those advanced chips. Samsung in South Korea is another giant in chips and hardware. Investing internationally lets you own these vital non-American choke points. Finally, diversifying internationally is also a form of currency diversification. When you only own U.S. assets, your entire net worth is in dollars. By owning assets denominated in euros, yen, or Swiss francs, you're hedging against the risk of a declining dollar and spreading your currency risk. So how am I doing this? I'm adding 2 broad, low-cost global index funds that exclude the U.S. This isn't about trying to pick the next foreign stock superstar. It's about systematically reducing my portfolio's home country bias. After a decade of U.S. outperformance, this kind of diversification feels less like a choice and more like a survival tactic. My third change is a shift in how I invest in AI itself. I'm moving away from obvious mega-cap names toward the AI underdogs. The first phase was the infrastructure build-out, the chips, the cloud, and the big models. The market has already priced this in. But the next, much larger phase will be about application. Thousands of companies using AI to create efficiencies and solve real-world problems. Think about it like the internet. In the early days, the big money was in companies like Cisco building the plumbing. But the truly massive wealth was created by companies like Amazon, Netflix, and Google that use the internet to transform their industries. The technology will eventually become a commodity, like electricity. The real value will go to companies that use it cleverly. In agriculture, AI analyzes drone images to identify pests. In manufacturing, deep learning algorithms are used for quality control. In healthcare, AI is helping doctors diagnose diseases like cancer earlier and more accurately from medical scans and personalized data. These are the underdogs. They aren't on the front page, but they are where the next wave of productivity is coming from. This could be a logistics company, a biotech firm, or a software company that integrates AI to serve a niche industry. The challenge is, how do you find them? This is where passive investing completely breaks down. That's why I'm making a specific allocation to active management. Looking at specialized funds that focus on the application layer of AI, while everyone is jammed into mega-cap stocks. Finding the next generation of AI winners, the companies that apply the technology. My fourth change is about building a better defense. Owning uncorrelated assets like physical gold and infrastructure is essential. For centuries, gold has been the ultimate safe haven asset. It tends to do well during economic uncertainty and geopolitical turmoil. Central banks are aggressively buying gold to reduce dependence on the US dollar, providing a strong structural demand floor. The second part of this shift is infrastructure. The biggest bottleneck for AI is energy and data centers. Spending on AI infrastructure could reach $7 trillion by 2030. Electricity demand from data centers is projected to double. I'm investing in utility companies, real estate trusts, and industrial firms that make the electrical gear. These are the picks and shovels. This final change is the simplest, but might be the most powerful. I am increasing my cash position. Buffett understands that cash is not just for defense. It's a strategic weapon. Berkshire Hathaway holds a war chest of over $100 billion. When markets crash, cash doesn't. It cushions your portfolio and prevents you from being a forced seller at the worst time. Cash is the dry powder that lets you buy world-class assets when they go on sale at bargain prices. It's like Buffett in 2008. This AI-driven market is chaotic. Having a cash pile is my way of preparing for both the risks and the opportunities. To recap, I'm reducing my S&P 500 blind spot, looking abroad, hunting underdogs, embracing gold and infrastructure, and building a cash fortress. The world has changed, and our strategies must change with it. The rise of AI is the most powerful wealth creation engine of our lifetime. Acknowledge the trap, take proactive steps, and thrive. The old map doesn't work anymore. It's time to draw a new one. Thank you for watching, and see you in the next one.